Have you ever wondered why prices in the United States are still high, even when news says inflation is going down? Why groceries, rent, and fuel still feel expensive, while banks are also charging higher interest on loans and credit cards? What if I tell you that inflation and interest rates are playing a hidden game that directly controls your daily life, your savings, and even your future? Stay with me because in the next few minutes, you'll clearly understand this powerful connection that most people don't fully realize. Before we go deeper, make sure you like this video and subscribe to the channel because here on The Silent Truth, we break down complex global realities into simple, eye-opening explanations that truly matter. Now, imagine this simple situation. You go to a store and suddenly the price of milk, bread, and eggs has doubled. This is inflation. Inflation simply means that the prices of goods and services are rising and your money is losing its value. The same $100 that once filled your shopping cart now feels like nothing. In recent years, many Americans have experienced this exact situation. Prices went up quickly and people started struggling to manage their daily expenses. But here is where things become interesting. When inflation rises too fast, the Central Bank of the United States, known as the Federal Reserve, steps in to control it. And how does it do that? By increasing interest rates. Now you might ask, what exactly are interest rates? Simply put, interest rates are the cost of borrowing money. When rates go up, loans become expensive, credit cards charge more, mortgages become heavier, and businesses think twice before borrowing money. Now let's connect the dots. When the Federal Reserve increases interest rates, people borrow less money. When people borrow less, they spend less. And when spending slows down, businesses cannot raise prices as easily. This is how higher interest rates are used as a tool to control inflation. It's like applying brakes to a speeding car. The economy slows down just enough to bring prices under control. But this process is not as simple as it sounds. It comes with serious side effects. When interest rates rise, buying a home becomes difficult because mortgage payments increase. Small businesses struggle to expand because loans are expensive. Even job growth can slow down because companies start cutting costs. So while inflation may start to fall, the pressure on people's lives does not immediately disappear. Now, here's the real question. Why do people still feel that everything is expensive even when inflation is reported to be going down? The answer is very important. When inflation decreases, it does not mean prices are falling. It simply means prices are rising at a slower rate. For example, if prices increased by 10% last year and 3% this year, they are still increasing, just not as fast. That's why many Americans feel no relief. Their salaries are not increasing as quickly as prices, and the cost of living continues to feel heavy. Let me give you a real-life example. Imagine rent increased from $1,000 to $1,500 in 1 year. The next year, it increases to $1,550. Inflation is lower in the second year, but rent is still higher than before. This is the reality many people are facing across the United States today. Another important factor is credit card debt. When interest rates are high, people who rely on credit cards end up paying much more in interest. Many Americans are unable to pay their full balance each month, which means their debt keeps growing. This creates a cycle where people are working hard, but a big portion of their income goes into paying interest instead of improving their lives. At the same time, savings become slightly more attractive because banks offer better returns when interest rates are high. But here's the catch. Most people don't have enough savings to benefit from this. Instead, they are dealing with loans, rent, and daily expenses. So the benefit is limited while the pressure is widespread. Now, let's talk about the bigger picture. The relationship between inflation and interest rates is like a balancing act. If interest rates are too low, people borrow and spend more, which can cause inflation to rise. If interest rates are too high, spending slows too much, and the economy can move toward a recession. The Federal Reserve is constantly trying to find the perfect balance, but it is not an easy task. Even a small mistake can impact millions of lives. And this is where uncertainty comes in. People don't know whether rates will go higher or lower. Businesses don't know whether to invest or wait. This uncertainty itself slows down economic growth. It creates fear, and fear reduces spending. When spending reduces too much, it can lead to job losses and economic slowdown. Another hidden truth is that inflation does not affect everyone equally. Wealthy individuals with assets like property or stocks may still benefit because their assets increase in value. But middle-class and low-income families suffer the most because their income does not rise at the same speed as prices. This creates a widening gap between different groups in society. Now think about this. High inflation hurts your purchasing power, and high interest rates increase your financial burden. So in this situation, people feel trapped from both sides. They are paying more for everything, and at the same time, borrowing money becomes more expensive. This double pressure is exactly what many Americans are experiencing right now. But is there any solution? The reality is that controlling inflation takes time. Interest rate policies do not show results immediately. It can take months or even years for the full effect to be seen. That's why people often feel that nothing is improving, even when policymakers claim that things are under control. One important thing to understand is that a stable economy requires patience. Quick fixes can sometimes create bigger problems. The goal is not just to reduce inflation, but to do it without causing a major economic crash. And that is a very delicate process. Now, I want you to think about your own life. How have rising prices and higher interest rates affected you or people around you? Are people saving less? Are they struggling with bills? Are they delaying big decisions like buying a home or starting a business? These small changes reflect a much bigger economic reality. As we move forward, the big question remains, will inflation come fully under control and will interest rates start to fall? Or will this pressure continue for a longer time? No one can predict with certainty, but one thing is clear. Understanding this relationship gives you power. It helps you make smarter decisions about spending, saving, and planning your future. And this is exactly why the silent truth exists, to simplify these complex realities so you can stay informed and aware in a fast-changing world. If you found this explanation helpful, make sure to share this video with others so they can also understand what's really happening behind the scenes. And don't forget to comment below and tell me your thoughts. Do you think interest rates are helping control inflation, or are they making life harder for ordinary people? Your opinion matters, and I would love to hear from you.